Steph, but I think we got kind of lost in the weeds because taking a step back again, really looking at like the whole picture of saying, okay, well, where do dollars come from in the first place? Was what we were talking about, and we were talking about the national debt and whether or not is that what do we mean? Is it a debt? If it's a debt, what do we mean by this? A debt? Because here's these weird guys coming on saying it's actually good for the private economy because now they have money. What does that mean, right?
So you're saying that the government, by creating debt, is
transferring
money to the private sector?
I'm sorry, I was
sorry. I apologize. So the government, by creating currency, by selling bonds and so on, is transferring resources to the private sector. And I'm sorry if I've oversimplified that.
It's actually transferring resources to the public sector because it's creating fake nothingness out of thin air.
No, it's literally resource to the private sector. Steph is correct, right?
Let me finish my point, Niva, because the government creates the nothing, the money, and then buys resources from the private sector. And the government gets the real resources.
Yeah. So the resources,
and the private sector gets money.
The financial assets move to the private sector.
Okay, financial assets. Fine.
But then also they also hire people, send out stimmy checks where they don't actually move any resources to the private sector.
Good point.
Public sector, FYI. But most definitely, they're moving financial assets to the private sector when they deficit spend money.
Okay, so they move assets to the private sector, and then the private sector may sell stuff to the government, in which case it would be a transfer of labor or materials or something to the government. But by creating debt, it's putting resources in the hands of the private sector.
By creating the in quotes debt, and part of the argument here is we're saying that the debt from the money issuer is categorically different from the debt of a money user.
Right. I agree with that. For sure.
Remember, so the stock conversation we went into, like the whether it's liability or an asset with the person buying the money of the stock or whatever, that's all predicated on the fact that there's some money to buy stocks with to begin with.
Right.
And that money has to come from somewhere. And right now it comes from the sovereign monopoly issuer of the currency, in which, if we're talking about the United States, is the United States government. So at like the beginning of like, in the beginning, there was nothing, and God said, let there be light, and let there be light. It's kind of like, well, in the beginning, there was the government, and the government said, let there be money, and there was money.
Let that be a
and
wallpaper of Andrew Jackson's. Yeah, okay.
So then there's something to work with. I think, I mean, Nima, correct me if you think I'm coming at this from the think
I want to hear what Steph, what the contention is.
Keep going. I'll hold my thought.
Okay, so that's kind of the first step. Now, whether that's good or that's bad, I think is a very important conversation to have. But me and Nima were coming out here going, okay, before we have that conversation, let's just describe the situation as it is right now. And the situation as it is right now is that's how money gets created. Is it gets created through this thing that we call national debt or national deficit. And then then the private sector has something to work with in order to make an economy from.
Sorry, in order to make an economy what? I didn't get that last word.
From. They have
an economy from. Okay, sorry, I was expecting a different word and my brain assembled the wrong jigsaw piece. Sorry, go ahead.
Sorry. Yeah. So that is the lifeblood that the private sector needs. And historically speaking, it's funny that when I compared MMT, modern monetary theory, to physics, you're like, wow, there's a big leap there, which on one hand is true. But on the other hand, we want to always point, okay, what's the evidence backing up what we're saying? In United States history, ignoring COVID for a second, because that was bizarre, there have been 7 recessions / depressions. Every single one of those depressions / recessions have been
depression.
What about the Great Recession 2008?
Okay, so Great Recession. Okay, if we count that.
Okay, whatever. Bad economic downturn.
But yeah, okay, go ahead.
Yeah. But all bad economic downturns were preceded by either a surplus in the government or paying off or trying to pay off the national debt. And from the MMT perspective, this totally makes sense because basically what you're doing is you're destroying the net savings of the private sector, and then the private sector goes, we don't have enough air, and it crashes. I could get more specific than that, but I thought that was an apt metaphor at the moment.
I don't mind more specificity, and I'll give you the Austrian approach to that. And again, it's not just MMT versus Austrian, but so go ahead, and I'll sort of give what I think the Austrian answer would be. So
basically, I mean, there's really, historically speaking, two places where the money generation can come from. It's the sovereign issuer with the monopoly control over the currency, and the, in quotes, private banking system. And we say that in quotes because it's really like this private public partnership, because the banking system receives license from the government to do what it does. I think most people on the show by now, I think, know that when a bank makes a loan, they make that money it just comes out of thin air.
Yeah, they just type it into an account. Yeah.
They just type it in, and poof, it appears. And so was something like 97% of money of U.S. dollars or whatever consist of actually that bank money, right? So what happens is when the federal government starts pulling back its private sector net savings, so this is the MMT argument, starts pulling back its private sector net savings, in order for the economy to continue pushing, the only place it could go to is the, in quotes, private banking system, in quotes, because for reasons I described before. But because the private banking system, the net liability and asset is zero in the aggregate, and I would even argue is negative because it comes with an interest rate. As the economy keeps moving, in order to service its own debt, it has to continue to borrow from the private banking system, which creates an even bigger debt to service. So it has to keep pushing that forward until one little Jenga piece finally slides out and the whole thing comes crashing down.
Austerity,
like we saw in 2008. Yeah.
Austerity or government budget balancing or surpluses always go hand in hand with excessive private sector leverage. Interestingly, that is the process that you're describing there.
Yes.
Okay, so the Austrian answer, as far as I understand it, again, not being much of an expert, but I think the Austrian answer is that the more government interferes in voluntary free market exchange, the more distorted and misallocated, they always say, sort of misallocated resources. And so if the government decides to subsidize a whole bunch of agricultural development, we're going to pay you $1 million per acre of land that you turn to farm, then what will happen is you'll end up with a massive excess of farming with no particular place to sell goods that inevitably spoil. And you will end up starving by redirecting capital away from, say, industrialization or savings or education or whatever it could be, and subsidizing like crazy farmland. Then you end up with a misallocation of resources. And then the resources have to be reallocated more rationally because it's unsustainable. And that reallocation process is called a depression. And that's that. I think, again, forgive me if I've gone astray, but I think that's the general Austrian answer. And their evidence, of course, is that these things hit the business-to-business or the hyper-capital sector long before they hit the consumer sector, which is because there's resources being artificially applied. If governments subsidize massive amounts of housing, which, of course, they have in various times in the West, if they subsidize massive amounts of housing, then you'll get a huge number of houses built. Then there won't be as much demand. And then, I know it's hard to imagine these days, right? But there won't be as much demand. And then
just think about China and their massive,
China, these massive cities, or of course the 07-08 crisis, which we can sort of get into the causalities of that one. But basically, the idea is that the government interferes in the free flow of capital, usually diverting capital towards its political favors, its political favorites, and usually getting some kickbacks under the table and so on. And they'll build a whole bunch of white elephants or bric-a-bracs or monuments to itself, and then it's unsustainable. And then like you're holding 20-pound barbells above your head, you can't do it forever. And then that sort of sudden drop is when the capital has to be reallocated because there's no demand for the products of the excessively stimulated capital environment, if that makes sense.
Yeah, what you described just now is called the Austrian Business Cycle Theory by Ludwig von Mises. And I mean, you didn't describe it 100% accurately because Mises.
No, please correct it. Yeah, please correct it where I've gone astray. It's been a while since I've studied this stuff.
Yeah. No, I read basically everything from Mises, so I remember it pretty well. In Human Action, he describes the process but he doesn't talk about government deficits causing this process. He talks about artificially low interest rates changing the private sector's time preference. That is the Austrian Business Cycle Theory. And he suggests that changing time preference makes it look to the savers and to investors as though there is more demand for long-term capital goods than there actually is. So they start investing excessively in long-term capital goods at the expense of the consumer sector. And when it turns out that there was no real demand for those capital long-term goods, then the investment sector collapses and the depression ensues. That is.
Yeah, so I think the argument is that if the price of money is going up, it's because people are saving, and saving is deferred spending. So then people settle into longer term projects. And so if the government suppresses interest rates, then you're also saying people are spending now and want to lend their money now because the price of money is cheaper. So you're right. And thank you for bringing that. A very important point is that the interest rates signal the relationship between saving and spending. And I mean, I remember this in the business world. There were certain times where it was just very hard to sell stuff. Summer was tough to sell because everyone's on vacation, and Christmas, forget about it. A lot of businesses kind of at the high level shut down for a week or two over Christmas and New Year's. But you expect that there are going to be more sales. Or people would say, well, it's not in my budget for this year, but I'll put it in my budget for next year and all of that. So, yeah, what you invest in, if you're expecting a whole bunch of sales down the road, you have to build your infrastructure now to produce the goods. And so, yeah, by messing with interest rates, it does dial up and down to preferences and gives the wrong signals. But sorry, go ahead.
There's, in my opinion, there's one giant defeater for this whole theory, and that is...
Sorry, which theory? MMT or Austrian?
Austrian Business Cycle Theory. And that is the fact that the Federal Reserve never artificially lowers the interest rates. They always artificially raise the interest rate above zero, because if the Federal Reserve were to not intervene in the interbank lending system, if they actually allowed for the banking system, the interbank lending system, to be as free a market as possible, the interest rate would always fall to zero. So all their efforts are attempts to jack up the interest rate from zero to some other level. And to the extent that they don't do anything, the interbank lending rate would naturally fall to zero, because banks always have an incentive to lend out reserves. They have no incentive to hold reserves other than statutory requirements and cash withdrawals and interbank clearing and tax payments.
But sorry, why would they lend money at 0% interest rate? Because there's labor involved in lending the money. Wouldn't that be a loss?
Zero. It would be maybe 0.1, because they want to economize on their reserves. It would be easier for them with the push of a button to loan out a reserve to another bank that happens to need it than to actually holding on to reserves restrains a bank's ability to lend, especially because of the stupid Basel regulations. They actually count reserves as assets, even though reserves as a risky asset, even though reserves are a completely safe asset. So they prefer to economize on their reserves and loan them out to other banks who are short reserves at the moment.
Oh, so you're talking like the sort of 30-day, 60-day, 90-day lending windows?
Overnight.
Overnight. Yeah. So overnight. Yes, of course. Sorry. So it's the shortness. They wouldn't do it for zero, but they do it for $10 on 10,000, because you might as well get that rather than nothing, especially if it's automated or some sort of computerized system, right?
Yes, it would tend towards zero. Is my point.
Okay. Sorry.
Maybe.
Well, and then if you could piggyback off this, that whatever rate that the Federal Reserve turns is arbitrarily and politically, not economically, turns its dial toward, the interbank lending rate is always just a smidge above it.
Yeah. So this is actually so understanding this whole process is very helpful in predicting interest rate movements and investing your money wisely and all that. Understanding long-term versus short-term rates, because I just explained to you the ultimate cause of the short-term rate is Fed policy. The ultimate cause of the long-term rate is the investors' expectations of all the individual short-term policies of the Fed within the individual 3-month periods of the term, for a 10-year bond, for a 30-year bond, whatever. It is a market bet on what the Fed is going to do. if the Fed chooses to not do quantitative easing, or they could just choose to do interest yield curve control like they do in Japan and just declare the interest rates on the entire term of the yield curve. And so this one, but my point is just the whole defeater for the notion that the Federal Reserve artificially lowers the interest rate is that the interest rate is actually always artificially elevated. My second point is that, as Dylan was just telling us earlier, these periods of excessive private sector leverage have always occurred with a government attempting to balance the budget or generate surpluses, not with the government trying to deficit spend. So much rather, the business cycle was encouraged by public sector austerity policy to where the private sector now is incentivized to go to the banking system and to go in debt to get the cash that they need. And that leads to excessive private sector to income, private sector debt to income leverage empirically.
If everybody who's watching this now or recording could like, share, and subscribe it helps us out a lot.
Yeah.
I hate saying it, but it's just true.